Big news. Just a few days ago, Scott Bessent, a former top manager for Soros, made a statement that shook Wall Street. The US dollar is facing its deepest crisis since the 1970s. For half a century, the greenback was the backbone of global trade, the universal currency through which almost every international deal was settled. But now, in August 2025, that foundation has cracked. The pressure is already visible in the numbers. In July alone, global investors pulled more than $13 billion out of American funds and redirected that money into Europe, Asia, and emerging markets. Capital is moving to places seen as safer and more profitable. And this is not just routine repositioning. This is the largest outflow in the last 4 years. Investors are not acting on a whim. They are looking for a safe haven and better returns, because they no longer believe in the stability of the US market. And the most important part, look at the sentiment of those making the decisions. The majority of institutional investors openly admit US stocks are overpriced. On the screens, they see numbers that do not match the real economy. And this is not just 1 or 2 opinions. A recent Bank of America survey showed 7 out of 10 fund managers expect stagflation. That toxic cocktail where inflation stays high while growth stalls. Even more shocking, 9 out of 10 believe US stocks are trading far above their fair value. That is why portfolios are shifting. Managers are cutting their US exposure and increasing holdings in gold, emerging market assets, and international markets. They are preparing for a period where growth freezes, inflation eats away at returns, and the dollar loses its appeal as a safe haven. This is not a short-term correction. This is the beginning of a massive restructuring of global finance. And to understand its scale, let's break down what the experts themselves are saying. The Bank of America survey leaves no room for doubt. 91% of participants said US stocks are overvalued. 70% believe the country is heading straight into stagflation. And these are not fringe opinions. Nearly 200 managers took part in the survey, overseeing nearly $500 billion in assets. When people managing that kind of money converge on one opinion, it's a signal. On the surface, the market looks strong. Indexes are near record highs. But that strength is held up by only a handful of giant tech companies. Behind them, entire sectors are weakening. For professionals, this is the classic late-cycle setup. Shiny numbers at the top, shaky foundations beneath. The picture gets even darker when you add policy to the mix. Inflation, which was expected to cool this year, actually ticked higher in July. Core inflation rose to 3.1%. At the same time, manufacturing and trade activity slowed. In other words, costs are rising while demand is weakening. That is the textbook definition of stagflation. And now add tariffs to the equation. Every time the US raises import duties, costs rise across the supply chain, from factories to store shelves. Companies pay more, and a few weeks later, consumers feel it at the checkout. This is where Trump's economic strategy comes into play. Tariffs were sold as a way to protect American workers, but in practice, they function like a hidden tax. This year, some new duties added an effective surcharge of more than 80% on imports. And here's the kicker. Within weeks, parts of those tariffs were suspended only to be reintroduced in different forms later. That kind of yo-yo makes planning impossible. Instead of expanding and hiring, businesses wait. They wait for clarity that never comes. And that hesitation drags growth down at the very moment inflation is climbing. For investors, the dilemma is crystal clear, a no-win situation. If companies pass tariffs onto prices, consumers lose purchasing power. If they keep prices steady, profits collapse. In both cases, markets suffer. And there's another threat: foreign buyers of US debt. If they start cutting their treasury purchases, yields will rise. That makes stocks even less attractive. This is why funds call the US market overpriced. They're not speculating, they're running the numbers. The result: the economy is trapped in a vice. On one side, slowing growth. On the other, stubborn inflation. And while markets on the surface look shiny, pressure is building underneath. And now all eyes are on the Federal Reserve. But the Fed's hands are tied. Look, inflation is accelerating again. Grocery bills are climbing. Energy remains expensive. Families are stretched thin. In theory, the Fed could cut rates to revive the economy, but that would only send inflation even higher. On the other hand, Keeping rates high squeezes businesses, makes credit unbearable, and risks popping the fragile stock market bubble. Either choice carries painful consequences. The labor market only makes the dilemma worse. Recent reports show hiring is slowing. Fewer new jobs are being created, and some industries are quietly trimming their workforce. Under normal conditions, that would be a clear signal for the Fed to cut rates and prevent a recession. But here's the problem. Jobs are cooling, while inflation isn't backing down. That creates a rare and dangerous mix. Weakening employment on one side and rising prices on the other. The Fed is trapped between conflicting signals. Whatever decision it makes, it risks acting too late and deepening the crisis. Investors see this and grow nervous. Hedge funds are pulling money out of equities. Gold and government bonds are back in style. And households are left worrying about the safety of their savings. When markets are overheated and the central bank is cornered, confidence can unravel very quickly, and the Fed's indecision itself becomes fuel for panic. The fear is that a single misstep could trigger a chain reaction across the entire economy. And here rises the big question: what happens when that fragile balance finally breaks? Everyone knows US stocks are overpriced, but the real issue isn't whether they will fall, it's how they will fall. There are two possible scenarios. If the correction happens gradually, the system might absorb the shock. But history shows that when valuations stretch this far, soft landings are rare. More often, the drop comes suddenly, shaking the system from top to bottom. Take today's indexes. The S&P 500 and Nasdaq are still hovering near record highs. On the surface, that looks like strength. But dig deeper, and the question arises: why are stocks so elevated if nearly every professional agrees they're overpriced? The answer lies in timing distortions created by Trump's tariff policies. When tariffs spiked earlier this year, companies rushed to import goods before the higher costs hit. That created a burst of demand, making the economy look stronger than it really was. Later, when some tariffs were paused or adjusted, businesses scrambled again to reorganize supply chains. That created another artificial surge in orders. Together, these waves pushed the market upward, but they weren't signs of genuine growth, just survival tactics. But all of this support for the market was only temporary. Once those artificial boosts fade, demand disappears, and with it, the illusion of growth. The real question is what happens next. If the correction comes slowly, the system might withstand the blow. But if the bubble bursts abruptly, the consequences could be catastrophic. In just weeks, trillions in paper wealth could evaporate. Pension funds would lose value, retirement accounts would shrink, and families would slash spending almost overnight. That's especially dangerous because consumer spending makes up nearly 70% of the US economy. When households start cutting back, growth stalls hard. And companies, already burdened by tariffs and rising costs, won't be able to make up the difference. Instead of investing and hiring, they'll cut budgets, freeze projects, and lay off workers. Then the spiral begins. Falling markets destroy confidence, and collapsing confidence drags the economy down even further. Meanwhile, prices for essentials, food, rent, energy, continue to climb. It's a vicious cycle. Here lies the greatest risk. In past crises, the Fed and the government had emergency tools: rate cuts, stimulus, debt-fueled bailouts. But today, those tools may prove useless or even dangerous. Why? Because inflation is already high. Any extra boost risks fueling it even more. That's why investors are uneasy. They're not reacting to rumors, but to hard numbers. Weak growth, stubborn inflation, shaky policies. The higher markets climb without real earnings behind them, the harsher the fall will be when the reckoning comes. And tariffs, which keep raising costs, only increase the probability of a hard correction. That's why funds and corporations are bracing for impact right now. The only question is whether the American public will recognize what's happening ahead of time, or only after it's too late. And while America struggles in this trap, another story is unfolding overseas. China is quietly seizing the moment and strengthening its dominance in global trade. While the US wrestles with tariffs and inflation, China is moving quietly but decisively. The year 2025 has become a breakthrough for Beijing. In just this year, Chinese exports grew by 6.1%. In July alone, they climbed another 7%, far above forecasts. And this at a time when global trade overall is slowing. But the most striking figure is China's surplus. This year it hit $683 billion, up 32% from the year before. Behind these dry numbers lies the real story. Chinese companies are thriving precisely where the dollar is losing ground. While US exporters falter, Chinese firms are capturing new markets. And this is no accident. It's the result of years of strategy. Currency swap agreements, trade in local currencies, new deals with Asia, Africa, and Latin America, all carefully built over time. Today, soybean shipments from Brazil to China are increasingly settled in yuan. When Russia delivers oil and gas to India, payments are made in yuan or rupees instead of dollars. One deal at a time, the global system is being rewired. For Washington, this is the iceberg straight ahead. Every transaction that bypasses the dollar chips away at its global role. And when multiplied across thousands of deals, it looks like an avalanche of de-dollarization. Treasury Secretary Scott Bessent finds himself in a trap. He can't roll back Trump's tariffs. The political blowback would be too strong. He can't force US exporters to swallow the higher costs. And he can't stop global investors from pulling money out of America. That leaves only one lever, the dollar itself. By letting it weaken, he buys the economy some breathing room. But the price is steep. A softer dollar makes US assets less attractive, drives more trade into other currencies, and fuels inflation at home. It's a vicious cycle. And while Washington struggles to stay afloat, global investors are already making their move quietly, quickly, and before the real collapse hits. One of the clearest examples comes from Canada's giant, the Ontario Teachers' Pension Plan. It's one of the largest pension funds in the world. And what did they do? In just a few months, they cut their exposure to dollar assets by more than half. Over $50 billion sold off, half the portfolio gone in a single strategic move. And they're far from alone. Across Europe and Asia, funds are scaling back their US holdings. What spooks them is a weakening dollar and the prospect of negative real returns. The logic is simple. A 10-year US Treasury bond today yields around 4%. But if inflation runs above 3% and the dollar loses another 10% of its value, those bonds guarantee losses instead of safety. What was once the world's most reliable investment now looks like a trap. Now imagine the scale of risk. Foreign investors hold nearly $80 trillion in US assets, stocks, bonds, treasuries. A 10% drop in the dollar instantly wipes out $8 trillion in value. If panic spreads and selling accelerates, this won't just be another market downturn. It would trigger a wave of capital flight powerful enough to redraw the map of the global financial system. What we're witnessing now may be only the first tremors. The real collapse could still be building beneath the surface. And when it hits, the shockwaves won't stop at Wall Street. They'll ripple across the entire world. We're standing on the edge of a new reset. The dollar, which for decades served as the backbone of the global economy, now risks losing that role. And already waiting in the wings is China, with its yuan and a growing network of trade alliances. The question isn't whether a crisis will come. The question is, how fast and how painful will it be? Will it unwind gradually, or will trillions in savings, pensions, and household wealth be wiped out in one violent crash? And while Washington debates tariffs and clings to short-term fixes, global money is quietly moving toward new centers of power. When the system finally cracks, it won't just change markets, it will change the balance of power on the planet.